still losing money in the markets while big players seem to always win? Think about it. Every time you enter a trade, follow all the rules, maybe even do your analysis, the market seems to have a mind of its own. Price spikes, stops you out, then reverses, leaving you frustrated, anxious, and questioning yourself. You start wondering, am I just unlucky? Or is there something bigger going on behind the scenes? Here's the truth. It's not luck. The market has hidden zones, secret areas where institutions wait silently, observing retail traders like hawks, waiting to collect the liquidity that we unknowingly leave behind. These zones are invisible to most traders because they don't understand the psychology driving market behavior, why retail traders panic, why stops cluster at certain points, and how every impulsive move we make becomes an opportunity for smart money to profit. Picture this. You think you're buying a breakout, feeling confident, only to realize that your stop loss was placed exactly where the big players plan to push the price, trigger orders, collect liquidity, and then move the market in their favor. It's frustrating, feels unfair, and it's exactly why most traders keep losing trade after trade. But here's the exciting part. Once you start recognizing these hidden market zones, learning to read the patterns and understanding why institutions act the way they do, you can stop being the prey and start trading with the mindset of the pros. In this video, we'll reveal these secret zones, explain why so many traders ignore them, and show you how to navigate the market with precision and an edge that most people never see. To really understand these hidden market zones, we need to step inside the minds of the big players, the institutions, hedge funds, and smart money operators. Unlike retail traders who enter with small positions, institutions deal with millions, sometimes billions, and they can't just click buy or sell like you and me. They need liquidity, and liquidity only comes when retail traders are active, placing stop losses, chasing breakouts, and creating predictable patterns. That's why these hidden zones exist. They are areas on the chart where liquidity clusters around previous highs, lows, consolidation points, and failed breakouts. Now, one of the most powerful ways to spot these hidden zones is by understanding something called the fair value gap, or FVG. An FVG happens when price moves so aggressively that one candle doesn't overlap the next, leaving a small gap. To the untrained eye, it's just another move. But for institutions, this gap is like unfinished business. They often come back to these gaps, using them as re-entry points to add positions or reverse the market. Imagine a 3-candle sequence, a big bullish candle, followed by another strong bullish candle, leaving behind a gap in price where no trading really happened. That gap is an FVG, and it tells you where smart money is likely to return. Alongside FVGs, there's another concept you must know: order blocks. An order block is the last bullish or bearish candle before a massive move. Think of it as the footprint of the institutions, the zone where they place their large orders. When price returns to that block later, it often reacts strongly because the big players are still interested in defending that area. Now here's where the real edge comes in. When you see an FVG lining up with an order block, you're looking at a high probability hidden market zone. It's not just random price action anymore. It's the exact area where institutions are most likely to make their next move. Retail traders ignore these details. They're too busy chasing the breakout or reacting emotionally. But institutions, they're patient. They wait for price to come back into these zones where retail traders have already left their stops and limit orders sitting like bait. Once the liquidity is collected, the smart money enters, and that's when the real move begins. If you can spot these hidden market zones, FVGs, order blocks, liquidity pools, you stop trading against the tide and start positioning yourself with the tide. Now let's talk about the mistakes that almost every retail trader makes when dealing with these zones, because this is exactly where institutions take advantage. The first big mistake is chasing breakouts. Price pushes above a recent high and traders jump in thinking the market will keep going higher. But what usually happens? Price snaps back, wipes out their positions, and continues in the opposite direction. Why? Because that breakout level was a liquidity pool, an area full of stop losses and buy orders that institutions needed to trigger before making their real move. The second mistake is ignoring confluence. Retail traders see one sign, maybe a moving average cross or a breakout candle, and they enter without checking whether it aligns with an FVG, an order block, or a liquidity pool. Institutions don't trade on one signal. They build positions at zones where multiple factors line up, because that's where the largest liquidity exists. The third mistake is emotional trading. A trader sees price moving fast, feels FOMO, and jumps in late. But remember, if you're seeing a move that feels too obvious, chances are the big players are already unloading their positions and you're the one left holding the bag. Now let's see how to flip this around with an example. Imagine price is trending upward and suddenly leaves behind a bullish fair value gap. A few candles later, price returns to that gap and just below it sits an order block, the last bearish candle before the rally. At the same time, above the recent swing high, you know retail traders have their buy stops waiting. Here's what happens. Institutions push price down into the order block, filling their positions while triggering panic among retail traders. Once they've collected enough liquidity, the market shoots up, clears those stops above the swing high, and continues the rally. If you were chasing the breakout, you would have been trapped. But if you identified the hidden zone, the FVG aligning with the order block, you could have entered at the same spot as the institutions, placed your stop below the block, and targeted the liquidity above. That's how you stop being hunted and start trading like the hunter. So what are the key takeaways you need to remember about hidden market zones? First, the market isn't random. It's designed to move toward liquidity because that's where the big players can place their massive orders. Second, these liquidity pools often sit around obvious levels, previous highs and lows, consolidation zones, fair value gaps, and order blocks. If you can learn to identify these areas, you'll begin to see the market the way institutions do. Third, stop chasing every move you see. Instead, train yourself to wait for price to return to these hidden zones. Patience is the real edge. The traders who rush in get trapped. The traders who wait for confirmation near liquidity zones are the ones who profit. Fourth, always look for confluence. A single signal means nothing, but when an FVG aligns with an order block or a liquidity pool, you're seeing the exact areas where smart money is active. And finally, remember this: the market will always create stories to trick you. Fake breakouts, sudden spikes, emotional traps. But if you know where the hidden market zones are, you don't fall for the story. You follow the footprint of institutions. That's how you move from being part of the 90% who lose into the minority who consistently win. If this opened your eyes and you want to keep learning these insider strategies, make sure you subscribe and hit the bell, because in the next videos, we'll go even deeper into how institutions manipulate liquidity, how to use fair value gaps with precision, and how to build real strategies around them. The more you understand these hidden zones, the less you'll feel like the market is against you, and the more you'll finally start trading with confidence, just like the pros.